afternoon and welcome to the long-awaited webinar with Surge Energy to discuss their acquisition from Enerplus and their operational update. Surge trades under the ticker symbol SGY on the TSX and ZPTAF on the OTC. With us today from the company is Paul Colborne, CEO, and Derek Christie, Senior VP of Geosciences. You certainly had an exciting few months since our last update with a 4,000 BOE a day acquisition, or close to anyway, from Enerplus, upsized equity deal, and an increase, well, coming on your dividend. So congratulations. It's been proven that your timely, astute acquisitions have really built a great company and put you also in good running for index addition, given the size increase. Really excited to hear what you guys have going on today. And so I'll let you kind of take it from here. And just a reminder that your presentation may contain forward-looking statements. We will have time for Q&A after the presentation. So please put any questions you have in the Q&A box. Over to you, Paul and Derek.
Sounds great. Thanks for the intro, Jess. And we're thrilled to be here. Thanks for taking the time. We just got back last week from 2 conferences in Toronto. Amazing response. I think the oil industry is back as a leading top performing sector in the world right now, as one of the only sectors in a otherwise very difficult time. Oil companies are putting, like Surge, record profits and cash flows. I'm Paul, that's Derek, as you mentioned. So what we're going to do is about an 18-minute presentation overview, open it up for questions at the end. I guess the exciting thing for us is we've been chasing these assets. We announced a $245 million acquisition, $250 million deal, high quality, low decline, beautiful water flooded assets, right in our 2 core areas of Sparky and Southeast Saskatchewan. 12% decline, nice drilling upside, providing a stay flat inventory of over 7 years, 45 locations. Here's the real key: 15% accretive, 15% accretive to our forecast 23 free cash flow per share. And we've already bumped the dividend 14%. We announced that yesterday from 42 cents to 48. Amazing fit for us. We'll walk you through. Derek will talk to you about the asset fit. Basically, the reception was amazing in Toronto and on our deal. I don't mind telling you, it's one of the best equity financings I've ever done. We announced the deal, $245 million. Enerplus took some stock. So we only needed about $40 million raise to keep a really good balance sheet. By the time I went to bed that night, the book was at $185 million. When I woke up at 5:30 to decide to big size the deal or not, the book was at $270 million on a $40 million raise. And 31 of the top institutions in Canada came in on a deal. So we big sized the deal to $80 million. What's our advantage? Why are these people coming in? It's an amazing asset quality that we bought, asset quality package. But it fits us. I'd love to say I've done this 4 times for the most successful companies in Canada with guys like Derek and Scott Saxberg and Kel Johnson, Peter Bannister as partners, but it's asset quality. Asset quality, I'd like to say it's me or Derek. Asset quality drives superior financial returns. And I'll show you what that means, but all I'm saying is high quality, low risk, low cost, water flooded conventional assets, while they outperform deep, expensive, tight rock with steep decline, high cost, huge fracs that don't water flood. It's literally that simple. And what's it drive at the end of the day, if you're disciplined, is free cash flow, the new earnings. So I only know 2 ways to value an oil company. This is one, this slide. And guys like Derek and Murray Bai, our COO, beaten this into me over the years. Your net asset value, as independently engineered by Sproul, one of the top firms in North America. We don't get to say what our NAV is. Our NAV is $24 a share. That's after a 3-month annual, 4-month annual beatdown session with one of the top firms in the world. So Surge's net asset value is $24 a share. There's no land, no seismic, and no tax pool value in that number. And it could go down a little, up a little this year with the building in we had an amazing year on reserves, but there's a bit of cost escalation, but it should be north of $24 a share or $20 a share this year, even maybe more. And we traded $9. So for an investor, it's phenomenal. The other way I know how to value an oil company is free cash flow. And it used to be cash flow per share, but a better result from analysts, top people have now said, well, isn't free cash flow, which is really earnings in our business. So what is left over after your costs of production? So it takes into account your decline, your production efficiencies, and your netbacks. Well, who has the best free cash flow yield in Canada? I didn't say it. National of the oil companies. We're 87% light and medium crude, no heavy oil, very little gas. We are your true crude oil play in the country. Eric Nuttall wrote it. We have the best 28% free cash flow yield. National Bank's written it. So those are the two best ways I know to value an oil company, and Surge leads the pack. On the macro front, you guys know this, just keeps you well informed. This is unprecedented in 120 years. There is no oil. There's no oil under the ground in OPEC. I just read a piece this morning. OPEC is 1.8 million barrels a day behind on the current quota that they're supposed to be delivering to the market. And it's caused by not the Russian invasion. It's caused by 8 years of chronic underinvestment. We were investing $800 billion a year US to replace declines of 5% and grow by 1 million to 2 million barrels a year. Well, the last 8 years, we've been spending $400 billion US, and we used all of OPEC's excess supply capability under the ground is all gone. What does well during high interest periods and high inflation periods, stagflationary times? Energy. But be careful of the word energy, because in Canada, I love natural gas, can't argue with that, but all I'm saying is the Trudeau government has turned down 19 LNG projects that were all privately funded. So we can't get the gas. We're landlocked. We can't get it to Asia where they pay up for it, or Europe. So when you see the word energy, I'm just saying energy does incredibly well in stagflationary times like we have now. But really, I would say the most clarity I see, it looks like a layup, is oil. And Surge is your oil story. Here's our guidance for the year. As Jess said, we revised everything up with the acquisition. 15% accretive to free cash flow, bumped our production from 21,000 to 25,000 barrels a day. Because we have such a low corporate decline, 23%, because we have a lot of water floods in our asset base, it only takes Derek and Murray by about 175 million of our 335 million in cash flow to stay flat. So that leaves 160 million of free cash with Surge. So a 66% payout ratio and one of the best balance sheets. How do we push that 28% free cash flow yield out to shareholders? That is our plan. We're doing it as we hit discretionary debt targets that we've set. We want to hit those. By Q3 of 2023 of this year, we should hit our next debt target. We are already revising up the dividend. Yesterday we did it. So sometime in the near the mid to late Q3, we would look to increase of about 50% the amount of cash that we can put out through a dividend, a share buyback. We'll start our normal course issuer bid, a dividend, base dividend, or special dividends added in there. And then this time next year, early in 2024, as we hit our next debt target, probably put in a growth wedge, just 2.5% to 3% growth. So we've been very clear to the market how we're going to push that huge free cash flow yield out. One thing we have in Surge that not a lot of people have, we have $1.5 billion of tax pools. 700 million of those are the 100% write-off high quality pools. So for over 4 years, we can keep the cash away from Justin Trudeau and push it out to our shareholders tax effectively. We have one of the best tax bases of anyone in our group. This slide I mentioned to you, I wish it was me and I wish it was Derek, but it's asset quality drives the results. Sure, we analyze and harness it and drill it, but the bottom line is This slide, we've tried to show it. How can I say it? Because I'm just a lawyer, so that non-technical business people like on this call can understand. So along the bottom of this chart is permeability. Less quality rock or tighter rock on the left, better, more competent rock on the right. And again, it's this simple. Deep, expensive, tight rock with steep declines, huge fracks, huge costs that don't water flood, wildly underperform deep or shallow conventional, low risk, low cost reservoirs of water flood. It sounds trite, but the permeability chart on the bottom, 0.1 mil at RC and better rock, that's where surge lives. We don't want the risk in the technical risk, the cost risk, but also the business risk of the deep, expensive reservoirs. You don't have to take that on with surge. We're over here on the quality rock with the way better rates of return. So this next slide is where Derek's going to take over. And what he's going to show you on this slide is, what does all that mean to you people on the call? To me, I'm a big shareholder. What does it mean when we say we have the best quality asset base in the group? And he's going to show you that. Derek?
Okay, great. Thanks, Paul. So quite a few numbers on this slide, but I'll just walk through the highlights and the most important ones. So 3 billion barrels of oil in place. That's what Surge owns on its lands, net oil in place. Of that, only 7.5% of that has been recovered to date. And then only 10.5% of that is booked in our independent Sproul NAV that Paul spoke about earlier. When you think of reservoirs like this, what sort of recovery factors are you going to get? Well, on a primary recovery factor basis, you're going to see recovery factors of 20% or slightly higher with some of our Southeast Saskatchewan properties. And then when you think of water flood, you're going to see recoveries up to about 30%. So again, 3 billion, 7.5 cum to date, 10.5 booked, and then a runway up to a 30% recovery factor. And when you think of just a 1% change on 3 billion barrels, well, that's 30 million barrels of recoverable oil. Put that into perspective in a couple of ways. Well, our entire booked PDP reserve base is 35 million barrels. So this 1% change essentially doubles our PDP reserve base. And then when you think of it on a value basis, just a 1% change at that's 30 million barrels. You throw on using a net back of $40. That's $1.2 billion. So very very significant with just a small change in recovery factor.
And $1.2 billion of value is equal to the entire enterprise value of Surge is about 1.3. So a 1% change in recovery factor, we think we're going to get easily 10, closer to 20 under flood over the years. It's amazing torque is what we're trying to illustrate.
And then just in the middle column, you can see our drilling locations. So we have over 1,000 drilling locations as a company, 12-year solid inventory, and less than half of those are booked in our independent Sproul report. Now highlighting just our top two plays are Sparky and Southeast Saskatchewan. We really offer exposure to 2 of the top 4 conventional plays in Canada. Of that, so 75% of our production comes from those 2 areas. And then importantly, 90% of our capital for this year will be spent in those 2 areas. So why? Why are we spending all of our money in those 2 areas? Well, this is some independent research that was done by Raymond James. And what it did is it ranked all of the oil plays in Canada. The basis for ranking is when a well reaches a 2 times payout. So you drill a well, you get your money back. And then when you get your money back again, and then all those plays were ranked. The top plays that came out of that were the Clearwater, Southeast Saskatchewan conventional, our Sparky core, and then the Charlie Lake. So not only do we have some exposure to those top plays, 2 of the top 4 plays, but really we have a dominant position in 2 of those top 4 plays, and 75% of our drilling inventory sits in those top plays. Recently, Peters & Co. has come up with some similar research. They just did it on a simple payout, but ended up with a very similar ranking just to kind of validate that work that had been done and our own thoughts on it. With the Sparky, so it's part of an 11 billion barrel oil trend. We're really focused in that light to medium gravity window. It's greater than 20 API. Some of the reasons why we really like the Sparky is just the amount of data that we have here. So there's over 20,000 vertical wells that have been drilled into this area. And then we have 3D seismic over essentially all of our core areas. Couple that with reservoir engineering, we ended up with a truly integrated reservoir model. So what does that mean? Well, what that's done for us is that we've drilled over 200 successful horizontal wells into the play, and then that gives us an inventory and de-risks our future inventory of 450 drilling locations. Also on this map, I'd just like to highlight the Enerplus acquisition. You can see how great it fits. You can see our Cadogan piece to the south, right in the heart of our play, and then the Gilt Edge property, water flooded property up to the north. So really fits very well with what we're doing out here. Importantly too, as part of the, with Enerplus, we got these great long life water flooded properties being Gilt Edge and then the Southeast Saskatchewan properties, 11, 12% decline. But then it also came with over 40 drilling locations, primarily in our Cadogan property, where we've recently drilled some offset wells, some of the best wells we've drilled on the Sparky. So a combined IP of those 4 wells that directly offset the 40 drilling locations we purchased is north of 700 barrels a day on a total basis from that pad. Some other highlights of the Sparky: low cost of drilling, one of the reasons we really like it. So it's that's 1.6 million drill complete equipment tie-in. As I mentioned before, great depth of inventory, 450 drilling locations, 11-year drilling inventory. And really now we've grown this from essentially zero with some strategic acquisitions and then some really great drilling results to the 11,000 barrels that we sit today.
So if you go back one quick slide, one thing I always like to mention is Derek walked you through the Raymond James study. Peters has said the same, National Bank. The Sparky ranks number 4. So it pays out 100% in about 9 months and pays out a second time the well, 100% profit in 2 years. This chart, though, does not account for water flood. So we book about 120,000 barrels on primary on this payout chart, which is great. Under water flood, we're booking up to 400,000 barrels with Sproul for a water flooded Sparky well. If you added that in on a full cycle basis, we believe that would bolt the Sparky to the top play in the Canada by quite a margin. The Clearwater may prove out some parts of it to flood, but it's heavier oil. Our Sparky gravity is like 24, 25 API across the 11,000 barrels that we have. So time will tell if it floods, but it's why it's turned out to be much better than we anticipated.
So jumping into Southeast Saskatchewan, relatively new area for us. We did 2 strategic private co-acquisitions in the last year, being Astra and FireSky. A lot of the reasons that we really like that, we targeted this as an area for a new entrant for Surge to complement our Sparky. We like the low cost of drilling here, so it's 1.4 million to drill complete equipment tie-in. Part of the reason why these wells are less expensive than our Sparky is that we do not need to frack them. We're drilling primarily into the Frobisher zone, which has really excellent primary porosity and permeability, so we do not need to stimulate these wells. So we get that, and then on top of that, we get very active water drive with the Frobisher properties. So you'll see recovery factors north of 30-35% on a primary basis. Another reason why we liked it was just the organic opportunities that we saw here through the work that we did with Astra, mostly through the acquisition of Astra. We had mapped a very large extension to the Steelman pool associated with the Astra-owned assets. Those that became available through a Crown land sale that we were successful at, which is great. You've got some raw land, but then late last year, so that came with 46 drilling locations. And then late last year, we kind of put the bit to the ground and tested that concept. And then we drilled a first 3-well pad, followed up with another 3-well pad, and some of the best results really in Saskatchewan last year. So, through some independent reports, you'll see from Peters ranking all of the top wells in Saskatchewan. These ones are just dominating that sheet. So it just goes to show these wells are IP30, about 500 barrels a day. So we've proven it up with the first few wells we've drilled, and now we have a real good depth of inventory of another 45 just on that land sale block, with another total of about 75 in the area. So again, really excited to be back here. We saw some great opportunities, and then you can also see where the Enerplus properties fit. They're in a slightly different zone, being the Ratcliffe. It's a zone that has been historically flooded shows a great response to that. So we see a lot of PDP upside associated with those properties. And it's just a great complement to our properties down here. Again, you can see just that depth of inventory that we have. So 240 drilling locations, great, 10-year inventory for us down here. Now we have a, 7,500 barrel a day production base and just the top tier economics. These recent wells we're drilling that I was quoting, these kind of 500 barrel a day IP30 wells, they're really paying out in 7 to 8 weeks. So it's exceptional economics and really excited to be back here.
I guess 2 last slides. Surge, we have a very good social conscience, I think, at Surge. Myself, Derek, Murray By, our COO, came from bigger companies. We were already abandoning 3 to 4 wells for every well we drilled, doing smart things, but I think I didn't do a great job of telling people about it. And now people are rightly caring more about it. So we're trying to explain the 2 acquisitions we mentioned, Astra and FireSky, in late 2021 we did. They were flaring gas. We said we can't do that. Tied in over 70% of the gas and reduced the greenhouse gas emissions through 2 pipeline projects in Southeast Saskatchewan. Over 70% reduction. Our board was 9 older gentlemen, and I said we can't do that. So we, about 3 years ago, interviewed and brought in 3 very highly qualified ladies with good track records. They've been amazing on our board, let 3 guys go. So a third of our board is top-notch female directors. Just letting people know that we're very socially conscious and trying to do a better job of talking about it. I guess the last point is Surge is going to be the top performer. Just look at who's been the top performer the last year. And really, it's not me, it's asset quality, it's net asset value. It shows up in so many ways, but it shows up in your NAV, the water floods. Our NAV's $24. Who's got the best free cash flow yield? Surge. Who's got the best asset quality and production efficiencies? As Derek showed you, we have 2 of the top 4 plays on that key point. So great balance sheet, and now starting to bump the dividend and push that 28% free cash flow yield out to shareholders with an amazing tax pool basis. We should be very tax efficient where a lot of our peers are paying cash taxes. So my point is, don't take our word. There's 11 of the top analysts in Canada. We have 3 other firms that want to come and write us up. We've been just yesterday moved up to Cormark's #1 oil pick in the country. We're almost everybody's top pick for oil because we're 87% oil. We're not gas, and we're not heavy oil. We're light and medium, as Derek showed you. So we're most of these companies' top picks in the intermediate space for oil in Canada. We agree. That's our story. Jess, we'd be happy to answer any questions if you have them.
I do have a few. Thank you. It's a lot to digest. And congratulations, as I know you've wanted your hands on these assets for a couple of years. So with that said, I know Enerplus hasn't, they flooded them and such, but hadn't really been after them aggressively with the drill bit. Do you see some good low-hanging fruit with this package?
Absolutely. As I mentioned, we have these great locations that are offsetting our Cadogan piece. So we'll be drilling those in Q1, we'll have a pad drilling. So we'll probably drill, maybe 8 to 10 wells on the Cadogan property this year. So we're going to really see the immediate value of that. And then we see some optimizations of the water floods as well. So we'll be working on that. So it's kind of twofold. The new locations that came that are really top tier in our company, top tier for anyone, and then just the optimizations we'll do with the water flood.
I'm hoping, Jess, that Derek will talk a little bit about Gilt Edge, but he's not so far. But we do see a play there that we're working on hard that he's keeping confidential. So,
okay. So I think Paul's asked the question, so I guess I better.
Yesterday and you stood me up, but
yeah. So part of what we're doing in the Sparky is also pushing our multi-leg horizontal well strategy. So to date we've drilled 13 Sparky multi-leg horizontals. Part of that has been targeting sort of the slightly heavier window, just north of that 20 API into the 18 API window. Gilt Edge falls directly in there, so we have some couple prospects, one that we've just recently drilled. Again, very excited about those initial results, and GeoTedge really helps to drive that strategy forward.
Okay, that's interesting. We talked, I think, a little bit about that area, but so you think there's really good, quite a bit of runway?
Yes, for sure. So it's and those are again unbooked locations that were not identified. So this is additional upside for us.
So you've been doing, like you said, some different drilling techniques with both on the Sparky and in the Frobisher wells. So do you think? I mean, let's go talk about the Frobisher. You know, you with IPs of 500 BOEs a day plus. Does this? Do you think you'll get an increase to your type curve? And what kind of declines do you see, like sort of after 3 to 6 months?
In that specific area, definitely those are top tier type curves. So those are those will upgrade from, you know, there'll be above our grade A type curve that we have, tier 1 plus. So they really rank right at the very top. When you think of a decline with these wells, so they're going to have about a 70% decline year one. So, but you get such high, the payback of these wells is so strong that, you know, it's within 6 or 7 weeks.
So you should be able to move some PDP into PUDs, I would think, as well, because of this.
Yes, but then actually with all of the land sale that I mentioned, that 46 wells, none of that would have been booked because that's all organic. So that will be in this year's reserve report that we're just finalizing.
Yeah, that's what okay. And same in the Sparky. Do you think you'll have a type curve increase there in some of the areas?
Yeah, when you see those wells, like I just talked about with the, you know, the individual well IPs of about 200 barrels, those are going to be some, you know, again, top tier. We're going to see some type curve increases in that particular area. So you're not going to see that a blanket across the entire Sparky inventory, but there's going to be specific spots that are going to definitely get a type curve increase.
Okay. I'm just going to your capital allocation. So how many wells will you drill? I mean, you have it broken down by percentage, but a number of wells for each area?
Yeah, so, you know, last year we drilled around 71 wells, net wells between the two areas. That would have been 40 in the Sparky, 31 in Southeast Saskatchewan net. Very similar split this year. You're going to see us drill close to 40 wells in the Sparky and then again about 30 in Southeast Saskatchewan. Of that, we have probably 6 multi-leg laterals in the Sparky planned, and then of the 30 wells in Saskatchewan, probably 15 of them will be in the Steelman area.
As I said, I mean, when you did your deal, you were a little, well, I guess you were a little closer to being to that one, well, not quite, but right after you did this deal, so that $1.1 billion mark that you need to be considered for the index. Would you, and I know you're always acquisitive, if the price is right and the assets are right, would you do another acquisition? Do you see anything that's sizable or smaller that you're eyeing right now and that's on the market? And how are you seeing pricing?
We don't hesitate when we see the elite reservoirs. So they're so lucrative if you can get your hands on them. Generally, like Whitecap put out their packages as 6 packages, and they tend to put 1 or 2 nice assets and then a bunch of sludgy stuff with ARO in it in one. Then the same. So we might like this or that package. Often we let them go no bid or no acceptable bid. And then we try and swoop in and pick out the elite reservoir that we want to own. Right now we have nothing that is right front and center on the books, but we're always out looking for, we hear Aspen Leaf might come in the spring here to the market. We hear Vermilion has a package out there. We heard that the soil deal failed. The Paul Sharon's company, what are they called? Ridgeback.
Yeah.
They sold their Charlie Lake to Archer, but the rest we heard is not going forward right now. So always out looking, but right now nothing on the front burner. And we're always reservoir specific, like Derek and Murray have their teams, and then we have our A&D group, and we descend and do our work on it and decide if we want to bid. So if we do see something really good, we don't hesitate to jump on it and try and get it. But We don't see much right now that fits our criteria. And that's the nice part about having a 12-year drilling inventory that Derek mentioned. You never want to drill your bottom third, but we probably have 7 or 8 years of tier 1, tier 2 juicy drilling and water floods to lean on. And we're always trying to add to that in our internal groups.
And you are certainly astute. Like Astra and Fire Sky totally changed the face of the company, even though you organically built the Sparky so well. It added a complete different layer to your story, and you levered at the same time.
And give credit to Derek and our team. The Steelman property we initially got was good. I think we saw 15 or 20 lokes there, but then beating out Whitecap at the Crown sale brought another 40. So we probably have 50 or 60 lokes at Steelman still remaining. So that play has turned out to be a bigger pool extension discovery than we anticipated. So we're kind of adding value already to those deals.
Well, I think this was key with your team. You are extremely good at, like I said, acquisitions and dispositions. But the technical aspect of your team is extremely strong as well. And that's something I don't think you get enough credit for, to be perfectly honest with you.
Don't say it too much, or Derek's going to ask me for a raise here.
I know. But it's been very phenomenal over the last few years for sure. Yeah. So back to just your financing. Historically, you didn't have a huge number of institutions in the name. Now I'm assuming that percentage has changed quite dramatically. Do you know what that would be? About 60%?
Yeah, so I think we were close to 85% retail 2 years ago. And I just was working it out with our CFO, Jared, that we could be as much as 35% institutional now. And maybe we were 15. I don't even know if we were 20, but 15 to 20, and we could be 40% institutional after the deal. Yeah, Jog Capital and Interplus is in there for 35 million of equity on the deal, and we tied them up for 3, 6, 9 month hold periods on the stock, so it's all got time horizons on it.
How do you always anticipate my questions before I? Okay, one from
because I've known you for 25 years, maybe that would be it.
That could be why. Just one more thing on inflationary pressures. Are you seeing them starting to stabilize? I'm hearing that from some companies in your area. But
yeah, so Q1 this year to Q1 from the previous year, we probably saw about a 20% increase in drilling costs. We're somewhat insulated because we do much smaller fracs, so we don't have the big pressure that the pressure pumpers are seeing, so we did see that spike up, and then now I would say that we're seeing really prices are plateauing. So when we think for the back half of the year, we don't see much more inflation in the areas that we're working in. In fact, that's one of the things that we've done is trying to control our costs wherever we can. So one of the things we've done is just to go to a real balanced drilling rig program. So we'll be running 1 rig in the Sparky, 1 rig in Southeast Saskatchewan, focusing on pad drilling, really focusing on the efficiencies to make sure that we can kind of do whatever we can to reduce those inflationary impacts.
One person here asking if you should have used more debt. Can you comment on why you raised so much equity for the acquisition versus using debt? Well, you get spanked for doing both. So
yeah, no, it's a good question, and believe me, we're all over it. We on a $245 million deal. It had a long effective date, so we were lucky and got the benefit of the cash to close moved. We got the incremental cash to close between May 1 and December 19. Worked out to the cash to close was about 202 million. Interplus took 35 million of stock. So we were thrilled to raise 80 million, but we were only going to raise 40 million as a minimum, and 80 would have been perfect. And as I said, when I went to bed on a 40 million raise that night, the book was 185. When I woke up at 5:30 and came into the office to big size it or not, the book was at $270 million with 31 of the top institutions in Canada in the deal. So we big sized it to 80 million. but that was our actual goal. The low, so we took on better 100 million of debt, give or take 110 million. So we did and that's what helped drive our debt was so low before the deal, but that's what helped drive the 15% accretion to the free cash flow per share. And for that shareholder or person that mentioned what you just said or asked the question, that's what also drove a nice 14% bump to the dividend. Yesterday, we announced that. So we think it dialed out almost perfectly to what we wanted, and we wanted to keep our one of the better balance sheets very pristine.
Yes,
good question, though. Yep,
through
good question.
that we all went through for years. Like
Yeah, exactly.
Yeah.
Good question, though.
Would you hesitate making acquisitions until your debt targets are met?
When you say that, it's we are always looking, and the debt targets are what our normal course of business is going to be. But if any given day a deal pops up that is those elite reservoirs we talked about, that's a nicely accretive good deal, we wouldn't hesitate, but we would always manage the debt to equity mix so that we come out of it with a good balance sheet. And we do want to see nice accretion. We want to see, minimum accretion levels hit on something. And to be truthful, I never thought in my wildest dreams we could get this for 245 million. We only paid 2.9 times cash flow. Normally you would pay for an elite asset like this 4.5, 5.5 times in a hot market, 6 times cash flow. We got it for 2.9 times annual cash flow. That's almost unheard of for water flooded units.
Yeah, no, that's it was definitely a great one. And they had been for sale for quite a while, I think.
Yeah. It's we're kind of tickled to just get the 4,000 barrels that we really wanted is what we got.
And then just one other quick question. Can you talk about which companies could be a natural fit with your companies/acreage?
Yeah, so really when you look at it, I'll tell you the one is Cenovus. I used to work at Husky Oil, and we built to Derek and Murray Buy's credit, an 11,000 barrel beast right in the middle of the Husky heavy oil corridor. We've stayed in the light and medium window, but man, that's Husky, Cenovus, CNRL, Baytex. Who else? We built a beast in the Sparky. And then when you look at us in Southeast Saskatchewan, we're 8,000 barrels a day now. We've got beautiful long lake water floods, some of the best wells in the province in the Frobisher. Derek and I are excited to get back into Southeast Sask because most every other company is selling out of there. CPG still trying to sell assets. Whitecap's got packages out. So we think we can go back in there with our technical expertise. We've already, we're out looking for other Frobisher pools similar to that Steelman pool that Derek showed you. So yeah, I think when you look at, if we're the only company we know with dominant operational positions in 2 of the top 4 plays, you can rest assured our dance car will be full if we decide to sell.
And like you said, everyone sort of was exiting Southeast Saskatchewan, right? And Saskatchewan in general.
Yeah.
Chasing these more expensive plays and the gassier, like you say, names. And now gas is not looking so bullish for the next, I'd say, quite a year, really. I don't think I have anything else, guys.
We appreciate the time. Thank you for having us on, Jess. Much appreciated.
Did I miss anything that the audience should know?
No, I will say this, as I said earlier, don't take our word for it. I believe 11 of the top analysts in Canada, Cormark just moved us as their #1 oil story in the country. We're going to outperform, and it's not me and it's not Derek. It's our asset quality will drive those results. And I love the dividend model of pushing out the cash to shareholders because it's their company. And the dividend with our tax pool situation being so good, we can push it out for the next 4 to 5 years and keep it away from Justin Trudeau and put it in our shareholders' hands. That's quite exciting for us.
And as far as your debt repayment, you're using $80 in your budget. Is that correct?
Yeah, that's the corporate thing here. We've used a lower number in our actual budget, but $80 it's over 80 today, or was when I came in here. So we think it's kind of what most companies are using right now, is around $80 flat.
Can you use the tax pools on the acquired assets that came with pools?
100%. So we will get another 245 million of pools on the Enerplus deal. So we're now over 1.5 billion of pools.
Is that within the 1.5, right?
Yeah, so we were 1.4, we crossed over year end, so we've used up some of them, but now 240 million come in. So it's kept us at over a 4-year horizon.
Which again, so like, yeah, if you look at your comps, I mean, they don't have the tax pools you do. A lot of them are trading at NAV, and certainly not at your free cash flow yield. So I don't really see, and your decline rate of 23%. I don't really see anything out there that is comparable to you at this level. And again, you're just getting to the size almost where you'll be included in the index, and you attract another level of investors. So well done, guys. Thank you very much. And
Thanks
you
for your time.
bought a new pair of shoes for me.
Thank you. No, great questions. Thanks for having us today, Jess. We appreciate it.
Thank you very much.
Okay, thank you.
All right.
See you.
Take care.